Hi, Eric. How are you today?
Good. Happy hump day.
Yes, happy hump day. So today is our final segment, and I thought it would be nice to just kind of talk about the different options. If you have a home to sell, in regards to buying the next house. I have, I would say 5 years ago, a lot of my clients were doing home sale contingencies. Of course, they had a home to sell before they could purchase the next home because they had money tied up in that home. These days it's a little more competitive with the seller's market. If a seller has even three offers and one of them is contingent on a home selling, that's not ideal for the seller because it might be an unknown. There is the opportunity to make an offer contingent on your home selling if it's under contract and moving toward a closing. I mean, that is definitely something that's, guaranteed, ready to go, already have a close date in mind. But I've had a lot of people ask me lately as well. I have a home to sell, and so I know that the market's really tough right now. So, I haven't even been looking at houses. We're adding a family member, or we're, moving, or whatever that looks like. But they're afraid to, not have a home to move into. So I'd like for you to kind of explain the different options to avoid having an official home sale contingency.
Yeah, it's a different world today that we live in, and definitely a different market. We as lenders have had to adapt over the past few years, and like you said, I mean, 5 years ago, if you had a home to sell, you would just make offers on a property contingent on your home eventually selling,
Mhm.
and those would be competitive offers. But now with 20, 30, 40 offers on properties, and with how competitive our offer is or our market is, those offers are just never getting accepted. So the solution is, well, there's multiple solutions, honestly, but the biggest solution is purchasing a home without your home sale contingency, meaning being able to buy a house without necessarily selling your house. Now, the first and the easiest way to structure this is a low down payment on the new home purchase. So
Mhm.
maybe something like a 5% down conventional mortgage on the new home purchase. What that allows you to do is when you close on that, you won't have a mortgage payment on that in the month that you close or the month following the month of your closing. So you could go anywhere from 31 to 60 days without having a mortgage payment. So it's going to give you some time to sell your house, move into the new house, clean out the old house, get it listed, get it sold, and
Yep.
then not have to make mortgage payments. And when you get your equity check or your net proceeds from your home sale, you can then do what's called recasting or re-amortize the loan that we've done for you. So that low down payment conventional loan, if you apply more funds to that loan, again, you can what's called recast or re-amortize the loan. It's simply put stretching the remaining loan balance over the remaining term,
Mhm.
as if you use those funds for your down payment in the very first place. In the very first place. That being said, in order to qualify for this option, two things: you have to have a 5% down payment on a conventional loan, and you have to qualify for both mortgage payments, the new home and your current home. And you also run the risk of potentially making two mortgage payments for a couple months before your home sale ends up being official.
Mhm.
In the long run, this option works out, but in the short run, there's a couple risks to it. The second option, let's say you don't have that 5% down payment, or you don't want to spend cash down. Um, the second option I always look at is retirement accounts. A lot of times 401ks and specific types of retirement accounts allow you to do what's called a loan against a 401k. This is when you're purchasing a house. First, there's no tax implications for this. Second, you can do this without, when you're buying a house, at least you can do this with up to a 15-year loan term. You're eligible to get up to 50% of the balance of your 401k. And the payments on the 401k are paid back pre-tax, just like your 401k contribution is pre-tax. Those payments on the loan can be pre-tax as well. You can also do a withdrawal from the 401k for the funds, because if you pay back with most 401k providers, You have to check the specific terms and verbiage of your 401k account. But with most 401k providers, you can, if you pay it back within 60 days, there's no tax implications whatsoever. So that allows you to go even above 50% of the 401k account. If those first two options don't work, we have what's called a bridge loan in-house. It is a loan against the equity of your current house. So if you have a bunch of equity in your current house and you don't want to spend any money out of pocket, we've closed a few of these over the past few weeks. They've been very successful, but they allow you to get the equity from your current home in a short-term loan structure where we use that then for the down payment on our new home purchase. And then again, when your home sells, the bridge loan does get paid off, just like your mortgage would get paid off at the closing of that home sale. So those are three different options that I typically see that we use to go without the home sale contingencies. Last but not least, and one thing to keep in mind, if you put your home into contract to sell and the contract does not have any financing contingencies or any remaining contingencies whatsoever, we don't have to count that mortgage payment against your monthly cash flow. So if you're having trouble qualifying for both mortgages, taking on two mortgage payments or something like that, you would simply go into contract to purchase and then list your home for sale, have the contract contingencies, whatever those are, those financing contingencies, usually appraisal or inspections. As long as those get removed, you're pretty much good to go.
It's kind of like a cash deal at that point, right?
Yeah, exactly.
Yeah, I've had several clients use all of these loans. Honestly, the mortgage recast was like a godsend. I will say, last year? No, 2 years ago. COVID has, created a gap in my memory. But anyway, I would say like probably 2, maybe even 3 years ago. I had clients who, I've been doing this for 11 years somehow. And I've had clients come back and say, I'm ready to buy my second house. And, how do I do that? And I'm kind of like, oh, I'm specialized in first time home buyers. I don't really know. So, I definitely found out about the mortgage recast, the bridge loan. And I believe you mentioned for the bridge loan, you have to be on the market, correct? That way, when you're on the market.
Yes. Great. Yeah, great point. You do have to be listed for sale on the MLS. So one of the contingencies of the bridge loan is that we put the home on the market for sale.
Okay. And it's just nice to know that people have options because I think, there's pros and cons to all of those. And, some people just don't want to have a second mortgage. In fact, or like, have the risk of having two mortgages at the same time. I will say a lot of my clients this year and even during COVID, kind of capitalized on the seller's market and just went ahead and rented. And that's okay. They're like, I'm just gonna, sell my house and I'm gonna rent and just kind of see what market we enter into. So, I never personally discourage renting if it makes more sense to somebody. And that's kind of, that would make me feel nervous if I, listed my house and I, was in contract on a house and I had to line everything up, but people do it all the time. So, that's something that both Aric and I can definitely help on, the home sell and, the loan side. So.
Yeah, absolutely. And I think that anybody that, kind of going back to that point about rent too, anybody that does, when you take a step back and you look at the housing market, people are saying, I hear a lot of our customers saying, wow, home prices are up, home prices are very high. They are the highest of all time in central Ohio, at least. Mm-hmm. But every day that you're not in the market and not in a house is a day that the prices are probably still going to continue to rise. Homes have appreciated or gone up in value 3 to 4% every single year.
Every year.
Other than 2008, that was the only economic recession that had home values impacted. Every other economic recession, home values were largely not impacted at all. And typically, when a recession happens that is more inflationary in nature, you actually see home values going up even further, which is, I think, what we're seeing really right now. It's simple supply and demand. If there's more buyers than there are sellers, home values are going to continue to rise. And every day that you're not in that market is money that you're losing because home prices continue to go up. And if you owned a home, your value is going to go up as well. It's not guaranteed. There are up years and down years, things like that. But in general, you can expect a 3 to 4% appreciation based on market averages here in Central Ohio.
Well, and I agree with all that. And I feel like too, like, when you're renting, I mean, I personally rented for the first 5 years I was in this business just because I didn't have the down payment. I didn't know where I wanted to be. I didn't know if real estate was the thing that I loved. It is.
Yeah,
Uh, but, I think that like, we get stuck on this hamster wheel, of renting. And then the problem is you're throwing away what, like $800 a month, which ends up being thousands of dollars over years. Where if you just get off that hamster wheel and you jump into a house, live there for 3 to 5 years, at least two. Let the natural inflation go up. It doesn't really matter if it's a buyer's or seller's market. Like Aric said, if you're paying down your mortgage and your payoff and you basically are increasing, you're in a decent area and your inflation is going up. And then, if you have multiple people searching for your house, then when you go to the next house, I think people fail to realize sometimes that the market that you're in is the market that somebody else is in. So, like, if you're
right,
selling and you're going to get more, you're going to also buy for a little bit more. So, you kind of get that
right.
step, I believe. So, as long as you can get out of the rat race of renting, if it makes sense and you have the money and, whatever, it only works for in your benefit from there. My first house, I
Absolutely.
used the equity in that house to buy my second house, like I mentioned the other day. And, I wouldn't have that money if I was renting and throwing away 15 to $20,000 a year. So
Mhm.
my two
Yeah,
cents.
absolutely. Yeah, it's tough right now in our market because while you can sell high, you're also buying at the high side of the market. But doing things like we were talking about earlier, where you're making an offer not contingent on your home sale, and some of the other strategies that we've talked about earlier in the week,
Mm-hmm.
you're really able to make the most competitive offer and at least try to put yourself in the ring to get a good deal on the home now, where getting a good deal now and being able to sell high really makes a lot of financial sense.
Mm-hmm.
Because again, I don't think that the difficulty in our market right now is selling your house for top dollar. I think the difficulty is buying a house and getting a good deal, and not having to go over list price and things like that. But there's a lot of strategies for that, and I'm really looking forward to the next few months here in Central Ohio, at least the summer months, where we see a lot more listings come available because of the school year. People don't want to move during the school year, and that's about to come to an end here in a couple weeks. So really, really excited to see where the market takes us.
Me too. And now that the mask mandate is going to start lifting and we're going to get back to a more normal, I like to say, we're not going to get back to
Right,
normal, but more normal. And I
the
think
new normal.
the new normal. And I feel like consumer confidence is going to go up. And people ask me all the time, do you think it's just going to roll over into a buyer's market and a, big bubble burst and a market crash? I really don't think so. The lending, restrictions, I think are so um, tight that people aren't getting loans for homes they can't afford. As Aric mentioned
Right.
the other day, you can only the debt to income ratio. You can't spend 70% of your monthly income on your house. I mean, you would literally be house poor, and that's risky for the bank. So I think that coupled with a fluctuation of supply and demand, I think that's definitely going to slow things down a little bit, but I don't know that we're going to roll directly into a buyer's market
Yeah,
housing
there's
or
there's a
anything.
lot of things that would have to happen for the market to drastically shift like that. Now, I do think that home prices will level off in some senses because we've seen extreme, percent above list price, and we've seen the highest, appreciation or home value increases in 1 year that we've seen in a long, long time in Central Ohio. And eventually, if there's more sellers, prices will start going up slower than they had historically. So again, I do think that we're definitely going to see interest rates go up over the next year and a half to start slowing this stuff down a little bit. We're definitely going to
We need a
see,
little bit of slowdown. Like COVID slowed
right,
us down. I feel like that was our reset. We need a little bit of slowdown in the housing market. That'll be a nice reset for everybody. So,
right. Yeah, yeah, absolutely. And we're definitely going to see, with increasing interest rates, maybe a little bit less buyers come to the table. And I think that the only thing that could really turn the market into a buyer's market would be massive unemployment, like we were projected to see during, when COVID first broke out. That's
mhm.
when we started seeing really a lot of problems because with massive unemployment comes a lot of people not able to pay rent and a lot of people not able to pay their mortgage. And those two things have a recipe for disaster in increasing foreclosures, increasing the amount of foreclosures, for example, that decreases the price of homes in neighborhoods at large, because if a foreclosure happens, the price of that home is drastically reduced compared to the market average. So that being said, the government has said, we have forbearance, we have all these different programs where foreclosures really haven't increased it to the level that they have said. So as long as the jobs market is able to continue to improve month over month as it has over the past 6 months, and I can't see us, going the other way as we continue to reopen and more jobs become available. I think that that's just going to continue to grow. Central Ohio, we're really blessed with a fantastic jobs market.
Mm-hmm.
And a lot of our jobs were considered essential. Like, a lot of our jobs, manufacturing, we have Facebook and Google and Amazon here. Like, a lot of these jobs were really
people were able to work from home, even though
able to work remotely, technology. So our jobs market, as we continue to reopen as well, will probably only go up and become more competitive, which draws more people to move here, which increases our buyers, which keeps the prices going up. Again, I think with rates increasing and rents, there's more rentals coming available. Hopefully it starts to level off or go up a little bit slower. There's a little less competition, but in general, we're not going to see any sort of market shift in the near future that we can really relatively predict.
I always tell my clients too, like, I have no crystal ball. We can hear from chief economists, and we can hear from all these people, and we can see what other states are doing and cities and things like that. But really, you can predict it, but it doesn't always go the way that you thought. We thought it was going to shift into a buyer's market, and there was going to be foreclosure with the forbearance, and then interest rates staying low, and people still being interested, and the mask mandates lifted, and so it's just very steady right now. I would say it's not as crazy as it was a couple months ago, and I think it's because we're starting to see a lot of inventory come to the market. So
yeah, like you just hit the nail on the head. I think inventory coming to market. The reality is every summer more inventory comes to market in Central Ohio than any other months. I mean, you probably know the numbers better than I do, but it seems to me like May, June, July, August, those are the months where most of our inventory year over year comes to market. And now we have a huge surplus of buyers ready to pounce on it, but it doesn't mean that, those are going to, it doesn't mean it's going to drastically shift the market or anything like that.
No. So, well, we will see. Again, no crystal ball, but we'll just kind of, roll with the punches. And Aric and I are here to answer any questions. And we are very excited to be on our Facebook Live tomorrow with anybody who would like to join. We'll be on Facebook Live. You can type in your questions. You can you can, send us love. But yeah, we're here to answer any of your questions on or off Facebook Live. So.
Yeah, absolutely. Really looking forward to the event. We'll put a link to the event in this video, and really, again, looking forward to answering any questions about anything that we've covered, from credit to how much you need to put down to the selling process, the buying process, the pre-approval process. We're really excited to share, and if you get value from this, definitely like and follow along with the Parrish team's YouTube channel. It's absolutely awesome and taking off. So definitely excited to answer some questions though tomorrow.
Yep, very excited. All right, guys, we'll see you tomorrow. Come hang out.
Thanks, guys.